Today we're going to be talking about cash flow, right? We're still talking about finances here. Over time, what we've done over the past two meetings, because you guys know that we've really moved into these four pillars of the business. When it comes to finances, we've already really dove into profit and loss, really understanding what drives profit, all right? What controls our profit? How do we increase profit? Then we went into our balance statement, which really informs us of how do we determine if we have a healthy business or not? All right. Now, what we're going to do is spend time talking about cash flow. Everybody loves cash flow. Everybody, says, hey, I got to get this many doors so I can get this cash flow so it can buy freedom. And so this brings up the term or the phrase where we hear often that cash is king. Some of you may have heard the term that cash flow is king. Right, and that's what we're going to be focusing on today, why cash flow is so important. This is just a recap. We've already discussed this in the past. I always keep this slide in here to really help highlight the importance of understanding our finances. I know finances are taboo. I know people don't really want to listen to numbers and accounting and everything else. But the more that we understand of how these finances work and how they impact everything that we do, it makes it a little bit more palatable, right? More easy to swallow this pill of complexity, right? So here's the thing, guys. With finances, at the end of the day, we start these businesses. We have all of these visions of things that we want to do, but ultimately what actually allows us to do it, it's the finances. It's the money that we end up creating that can fund that lifestyle, fund the dreams, fund the travel and everything else. Once we understand financing, this is our cheat sheet. There is no more guessing what's wrong in the company. We know exactly what's wrong and we know exactly what to work on. And I think that's the biggest takeaway when it comes to finances, because as entrepreneurs, we spend so much time saying, hey, you know what? I think we need better marketing. I think our marketing sucks. Oh man, you know what? I could really use this new system. I need a new hire. When in reality, all we're doing is guessing. We're going off of gut feelings. And that may work to a degree. But if we're going to play like the big boys, we need the data to back it up. All right. So here's some of the things coming up. We always do the coming up, right? So we're on cash flow today. Next, we're going to talk about how to budget properly, mastering the game of taxes, managing your money like the pros, right? Like the millionaires, how to really get down and understand how the company needs to manage money beyond what your personal money management is. Creating financial processes. Processes are something that we always harp on here within the Five Pillars Nation. We really want to focus on streamlining this, making things repeatable and consistent. How do we build out our financial team in-house or externally through third party? And then how do we get behind the tracking and creating financial strategy? That is the culmination of it all. Strategy refers to, hey, do we actually start a new business model? Do we do a vertical integration? Do we buy an extension for our company? Do we increase prices? Do we only focus on these specific clients? All of that is a strategy play. All right. So the first thing we're going to do is look at cash flow and profit. All right. So the real difference is profits is the difference between how much you've earned and how much you spent, right? Saying, hey, how much is left over? How much did I actually bring into the company as profit? Whereas cash flow is literally how much money came in versus how much money went out within a given period. All right. So if nothing happened within a week or nothing happened in a month and you spent a whole bunch of money, that shows a whole bunch of cash going out, but no cash coming in. So it's a key difference. It's a distinction that is important because so many times people think that they're profitable, but they say that they want financial freedom. They want the ability to sit back and not get a job or work part-time or have the business run itself. Well, if that's the case, guys, then what we really need is, yes, profitability, but we need cash flow to sustain that lifestyle. All right. We need a certain form of cash flow. So it can be profitable with low cash flow and vice versa. So here's a couple different examples. So Drake brought up a really good one of, hey, I only did my 2 flips for the year. So only at the times that I sold them did we actually receive positive cash flow, and then we got our profit from those 2 deals. So here's 2 other examples. You can put $1 into a flip and walk away at the end with $5 in your pocket. So there was a profit here. And in theory, if we look at it in relation, it was a high profit compared to the $1, right? But extremely low cash flow. So you could be profitable, but not have much cash flow. The other one here is you receive several new loans, but you haven't sold any products. So the loans, guys, that's cash coming in. So that loan isn't profit at all, but all of a sudden you can see that you have a high cash flow. You got $200,000 or so of cash flow, positive cash flow, but it had nothing to do with your profit. All right. So we can already see how this can be played. And hopefully this is highlighting some of the importance. And we're going to dive into more of that here. So how do we calculate cash flow? Guys, simple. All money in minus all money out in a given period. You want to see your cash flow for the month, quarter, year? It's too easy. What money actually hit the bank account and what money left the bank account? Loans, paying off debt, all that stuff, all that's included in the cash flow. Now, if you want the full equation, and this is where us as business owners, we get a little bit more meat on the bone here. It's cash flow from operation activities, cash flow from investing activities, and cash flow from financing activities. We're going to add all of those up to equal our total net cash flow. That's the real equation. We're going to break down each of these sections, right? So how do we go through and how do we read it? This is what a cash flow statement would look like if you print it off from QuickBooks. Now, this right here is just a breakdown of the different categories. Every single cash flow statement you're going to look at is going to be slightly different. It's going to be unique to your company or the specific company that you're looking at. But the flow and the diagram, the layout is the exact same. All right. You see, we have our operating activities, investing activities, and financing activities. All right. So let's break this down. First, we're going to look at operating activities. Now we'll show you a slide here in a second that breaks this all down. But you see the first thing it starts with is net income. That's the first thing it starts with. The net income comes from our income statement, our profit and loss statement, which we talked about 2 weeks ago, right? And this is basically saying, hey, at the end of the day, what am I being taxed on as far as income goes? That's our net income. All right, great. So now we know this net income comes in. This is our baseline for how much cash we have to spend inside of our operating activities. Then what you're going to see is adjustments. All right. Now, we talked a little bit during some of those last classes of when accounts receivables actually become important, right? Depending on our accounting method, we talked about that. We can see different Amex cards. There's going to be different types of payables and receivables, that all of these things are going to come into play to affect our overall cash flow. At the end of it, though, it's going to show us this is our net cash provided by our operating activities, all right? Our operating activities in this situation was able to produce net positive $102,000 worth of cash flow. All right, so we got that. So what does the operations basically say for us? So when we look at the operational cash flow, this is essentially is the net income for the company, but in a cash version. All right, this is all the cash that's been coming in and coming out. This includes transactions from all operational business activities. All right, everything that has to do with, hey, we're running here, so we need to pay for our marketing. We need to pay for our salaries. We need to pay for our rent, our utilities. We got money from book sales. We got money from merchandise. We got money from products or services. All of this is included inside of this one section. All right. So again, buying and selling inventory, supplies, paying its employees, salaries. Any other forms of inflows and outflows, such as investments, debts, or dividends, are not included in this area. It's going to be in the other two areas, all right? Now, here's the key that we're going to look at. This bottom line summarizes it all. Investors, lenders, people who want to buy your company, people who want to invest in your company, all this other stuff, they prefer companies that generate cash flow from business operations, not through investing and financing. Through business operations tells the world we know how to run a company. Our company can produce positive cash flow. Regardless of whether we get a loan, and we're going to talk about that in financing, regardless if we get a loan, we can be profitable. That's what it says. All right. So this is arguably one of the most important sections of the cash flow statement. All right. The next is our investing activities. And so you start to see some equipment in here. And basically what happens is you sum this up and you start to determine, hey, look, is it positive or negative? Now, before we go into this, think of investing activities, and we're going to dive into it a little bit deeper. This is like, hey, look, we're buying equipment. We're buying actual investments, right? We're buying things like this. So what this shows, this is the result of investment gains or losses in this section right here. This includes cash spent on property, plants, and equipment. Real estate investors are going to spend a lot of money here. Manufacturers, farmers, people who have big equipment, they're going to spend a lot of money here. This is where analysts look to find the changes in capital expenditures. This is where, as you're going in and you're reviewing a company, or if I'm reviewing a company and we're looking at your ability to function and run your investment portfolio of properties, we're coming here right away to see, all right, look, I see what your profit is. I got your NOI. We do the cap rate thing, whatever, we're good. But when we come here, it's where are all these big spending, where's the big spending going? If I come in here and I see, oh, okay, you put a lot of money into CapEx for roofs, for foundation, for whatever, then this may indicate that you're making investments into the future operations, right? Companies with high CapEx tend to be those that are growing. So there's nothing wrong with this being negative at the end of the day. Now, if it's negative, that for all of us, that should perk our interest to see why is it negative. If you're doing your own cash flow analysis here, guys, and you're seeing, holy shit, I made $100,000 in operations, but I spent $150,000 in investing. Now you can do a sanity check and say, did I spend it on the right things? Was the $150,000 actually going to items that helped me grow the company, or was I just blowing it off? Right? When we look at it, and we're looking at a potential property to buy, specifically within the commercial space, but within residential as well, we're going to come in here and we're going to like, all right, hold on. So I see the money you made, but you say that you spent $200,000 this year. The person says, yeah, but I spent most of it on CapEx. Okay, let me see your cash flow statement. Now I can tell if you lied and you actually spent most of it here in some sort of expense that you're not accounting for in your financial statement. Or if it's true and it was here in investing activities, let me see what you spent it on. Roof, foundation, whatever the case is. Right? So understanding how to read this now opens up an entire perspective that most investors and business owners will never touch. Right? All right, so we got that. And then the last one is going to be our financing activities. All right, so financing activities is an overview of cash use and business financing. Measure cash flows between a company and its owners and its creditors. Basically, this is debt and equity. All right. The owner for you, it's equity. It's your ownership in it. For creditors, it's the debt, it's the loans, it's the everything else. All right. Loans that are taken out and are paid back are typically listed here. All right. When we think about this and we're looking at the overall cash flow, remember we have operational cash flow up above. That's up top. Right? That's one of the first things we look at. During that, that's basically saying from our profit and loss, we've already cut out the COGS, or cost of sale, and we focused on how much we actually profited in the business. Nothing in that section talks about the loans that we took out for this. And so as we went back to one of our earlier examples, can we be high cash flow with very low profit? Absolutely. If I've taken out $500,000 in loans but haven't sold one product, my cash flow is going to look insane. It's going to look great. But we haven't earned an actual dollar yet. So looking and understanding where to look in the financing section is determine how much money are we actually using to function and run the business, right? Are we constantly covering our cash flow gaps with financing? Or can our operations actually support us? All right, so when it's a positive number in this section, it means there's more money coming in than going out, meaning you're borrowing more money than you're paying it off. Right? Or you're doing a contribution, you're committing more of a contribution out of your pocket than you're taking out in an owner distribution. When the number is negative, the company may be paying off debt or making its dividend payments or stock buybacks. All right. Now, the dividend payments and the stock buybacks, guys, that may be for higher level companies, but for us, it could just be our owner draws. Our owner draws can be considered the same as a dividend payment. Maybe you guys take owner draws quarterly based on your profits. There's nothing wrong with that. That's a great practice, as a matter of fact. Right? So understanding how that kind of plays in and what this is really saying. So again, if we have negative, that means, and you see owner draws here, so it means that this person elected to take $36,000 out of the company and put it in their own pocket. Is that a bad thing? No. It's not a bad thing at all. Matter of fact, it's your money. Hell, you better be able to enjoy it, you know? But maybe if it was saying, hey, it's $500,000 here, and we see that it's from a loan, now we got to ask the question, how the hell are we going to pay it back? And if you guys go back and watch the balance sheet video that we did last week, that's where we can determine if we're over borrowing, if we're over leveraged, so forth and so on. All right. Collectively, between the three of these statements, the income statement, the balance sheet, and the cash flow statement, we can tell everything we need to know about your company or any other company. There's no more guessing if you're doing things right. You quite literally know, hey, I need to change my entire business model. I need to focus only on these specific clients. My money management is horrible. I'm taking way too much debt out. My operations isn't even producing profit. You can answer all of these things just between these three statements. All right. So what does right look like? And so we've touched on these a little bit here, but most positive cash flow would be coming from the business operations. That's what right looks like. So immediately when you guys go back and look at your cash flow statement, is this the case? If it's not, that's an immediate area that you need to focus on, an area for improvement. All right. It shows the business can produce a profit and support other actions inside the company. This right here determines how much you can borrow, how much you can afford to pay, so forth and so on. Negative investing cash flows comes with proof of a capital expenditure, right? If you are so-called investing in the growth of the company, have the receipts, have the proof, have the track record, all right? This does two things. One, internally for you as a person. It gets to simply say, I'm a business owner. Hey, I spent this money. What did I spend it on? Oh, I got the receipt to remind me. Now I can ask myself the question, did whatever the hell I spend money on actually pay off? Right? Was it true investment in growth, or was this something that I think I needed and it bonkered out? Now you can help change your future decisions. Two, if you ever do decide to go to a private equity firm and sell to a different individual operator, or make your company go public, or whatever the case is, or bring on a private investor, having that proof will show them your intent as a business owner to help them understand, hey, you had good intentions. I can see the growth pattern. Now I know that you were thinking with your head screwed on. I can take this with more validity. Okay. And then the financing cash flows, these should be balancing out over time. So if money's coming in, it should be distributed out, right? Specifically with the loans, right? So any debt that's been incurred, are you actually paying it off, or are we just recycling money? There's a lot of us that's been through this where, hey, we got a loan. So what are we going to do? We're going to go out and get another loan to pay off this other loan. Cool. Keeps me breathing. I still got this capital to do something else. I got this loan, but let's refinance this loan. I'll get cash out from this and we'll do this and we're good. But what we're doing is consistently replacing the inflow for that outflow. And we have nothing showing that we have more of a positive inflow from equity or whatever the case is, right? We need it to balance out over time. If money goes out, money comes in, it has to go back out in the financing section. So that's what right looks like. So when you guys review yours, following this slide right here, this slide holistically, will be able to point you in the right direction if you're in good health or not. All right, so how to improve cash flow. So anytime that we look at cash flow, there's certain levers, as you guys have noticed now, for those who've actually seen the income statement class, the balance sheet class, everything about finances, guys, is different levers. Hey, people often say, I need more money to live, right? And so do we have to ask ourselves, all right, is that an increase in cash flow, or is that just an increase in our profitability? Which one is it? Because different levers means different pulley systems in the back, right? Profitability, maybe I just make my sales process more efficient. Or maybe I just spend less on marketing and get more efficient with marketing. Now I'm more profitable and I have more money. Or maybe, hey, we're so tight in profitability, like we're rocking and rolling. We're over 20% profit margins, but now we need more cash flow. All right, cool. So this right here specifically, how do we improve cash flow? So it's pretty easy. This first one, we have to start with this one because this is like the common ground base knowledge. Create more profit or net income. As you guys remember, that net income is the first line that we see on this cash flow statement, and it should be positive cash flow. So if we want to increase more cash flow by increasing that, it's too easy. So when we think about this, well, how else can we potentially increase our profits? Well, now we go into strategy. If you guys remember, our last session in the finance progress is going to be strategy. And strategy is, hey, maybe we increase pricing. Maybe we cut out certain services and products that have a low profit margin, and we only focus on the sales that have the high profit margin, right? How do we do that? All right, tying most debt to an income producing asset. So obviously it depends on the company, but there's a lot of companies that like to go out and spend money on equipment. For real estate agents, real estate investors, one of the most common ones you'll see is, hey, I'm going to get a company car. I'm going to put the car in my company's name. And that's fine. But you take out this debt, and we're talking about improving cash flow, that car only is a liability with the monthly payment. There's nothing that car is doing to produce income. So you've negatively affected your cash flow without a way to balance it out, right? So when we think about that, if we can tie the majority of our debt to income producing assets, rental real estate would be one, for an example. We have a mortgage, but we have rental coming in. This is a way to improve our cash flow, where we have an income to offset the outgoing debt. Improving your inventory. This is exactly what I talked about just a few seconds ago, where we're saying, hey, look, right now I'm working with buyers, sellers. I work with the occasional investor, and I work with wholesalers too, right, as an agent. Well, when we go through it, we realize that for investors, we're only making $1,500 commissions on average. With buyers, we're making $3,000 commissions on average. With sellers, we're making a $7,000 commission on average. Okay, well, I'm going to go ahead and get rid of the wholesalers and investors completely. I'm going to double down on the buyers and the sellers. I'm going to have 70% of my business be sellers and 30% be the buyers, right? Because I've done the analysis. Now I improve the inventory of which I'm operating. Inventory is your product and your services. It could be the same thing with your investment strategy now. Let's turn it on its head. Maybe, hey, I got short-term rentals here. I got long-term rentals here. I got a mobile home. I got whatever. Which ones are actually producing the most profit? Let me get rid of the low-hanging fruit, the stuff that's draining me, that isn't really positive in cash flow or profitability, and let me double down on the stuff that's actually working. That's what this process looks like of improving your inventory. And then this right here, sending out invoices immediately using electronic payment systems. All this is talking about is making sure that you're getting paid. Making sure that you're getting paid. For real estate agents, typically it's pretty simple because EXP or whatever firm you're with, they process that whole payment. Now, we've all been in a situation where sometimes they take a little bit too damn long and we're like, yo, hey, update, what's going on with my check? 2 weeks later, 3 weeks later, like, where the hell's my check at? That is kind of outside of our control. However, every single one of us could be charging for broker price of opinions, or CMAs, comparative market analysis. We could be charging for those. We could be charging for property tours, for showings for other agents, whatever the case is. But anytime we do that, the time difference in when we produce the service and when we collect the payment is extremely important. The quicker we can collect the payment, ideally we collect the payment prior to actually delivering the product or service, it's going to improve our cash flow, right? It's going to always improve to have the money come in faster. And then using some sort of high interest savings account, brokerage account, putting money in bonds, CDs, whatever. If we're going to have cash reserves that we're not going to touch, we can lock it up into something like bonds and CDs. If we have a cash reserve that we need to still remain liquid, we can go out and try to find the highest interest saving accounts that are out there. And we all know this ain't much, guys. It ain't like it's, a 30% savings account. It's going to be like 1 or 2%. But all of those dividends that we received, or those interest payments received, help us negate against our negative cash flow as well. All right. Other considerations here. This is what lenders care about primarily, guys. When we're looking for lenders, when we're helping our clients, if we have investor clients, if we're trying to get lenders to approve us, they want to know where the money is coming from, right? Is it from different loans and debt, or is it coming from operations, right? Where is the money going? Is the money going back out to the owner, or is it going to the company? And then, are you net positive in cash flow? If you're net positive in cash flow, that shows them that you are able to pay your obligations. You're able to pay back that debt.